Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I have as my guest Stephen Marshall, who is the co-founder, chairman, and managing partner of Cordiant Digital, ticker CORD, which has been listed on the stock market for about 4 years now. Has a market cap of somewhere in excess of £700 million and has been on something of a roller coaster ride since its IPO. I think that's fair to say. In fact, if I can summarize the story, I hope I get this right, Stephen. Basically, you came to the market, you raised 370 million at the outset, then traded at a premium, raised a whole chunk more. And then as we ran into the whole period of rising interest rates, wider discounts in the investment trust sector, saw the share price fall a long way and is now bouncing back strongly, has performed strongly over the last year or so. So, first of all, welcome to the podcast. For those who haven't followed this trust in great detail, perhaps you could just start by telling us what, in your terms, digital infrastructure means. We know the world is going digital, but essentially we're talking about things like fiber networks and mobile towers and digital data centers. But give us the broad picture of what you're doing.
Yes, Jonathan, that's absolutely correct. Digital infrastructure, as we define it anyway, is mobile telecommunication towers, data centers, and fiber optic networks. And these are all real assets, I guess loosely defined perhaps as the plumbing of the internet. The digital requirements that we all utilize on a daily basis require most of these assets in order to be able to deliver the services that we covet and look forward to.
And you say they're real assets, by which you mean that they are capable of delivering above inflation returns. Is that right? But you use gearing, of course, in the trust to produce those returns. You set out with a target of, I think, a 9% annualized total return when you came to the market. And you've met that, I think. How would you calibrate your performance so far in terms of at least of net asset value performance?
Certainly, we've been very successful, I think, over the last 4.5 years in delivering close on a 12% internal rate of return over that period of time in terms of growing the net asset value. And your reference to real assets, what I mean when I talk about real assets, Jonathan, is that it's the physical infrastructure. We actually own the physical mobile tower, we own the fiber optic networks, and we own the bricks and mortar that you require in a data center. We don't have a lot of technology risk in those real assets. These are somewhat like real estate plays, if you will, in terms of the real asset mix.
Okay, so they're bits of kit basically that you can feel them, you can see them in front of you, of course. Tell us then next, why did you come to the market over here to raise money and to run this business as an investment trust?
Well, we saw an opportunity in the market in that nobody was really giving the retail and the wealth managers access to a broad base of real digital assets. So we were the first, I think, of the kind in listing a pure digital infrastructure trust. Very shortly, soon after that, some of your listeners may well be aware that a second digital trust was listed called DGI9, again, investing in some of these digital assets that we invest in as well.
Yeah, I was going to come on to that. And of course, there's been a marked contrast between the performance of the two vehicles that you mentioned, yours and Digital 9 Infrastructure, which I'm allowed to say has been pretty much a disaster since it launched and is now being wound up. So you came to London, you raised the money here, mainly from institutions and wealth managers over here. If I look at your share register, who would I find broken down by retail versus institutional?
Well, we primarily have large wealth managers, fund managers, some institutional investors, and a little bit of retail. But retail tends to be somewhat more challenging, I think. The platforms that most retail investors use make it a little bit difficult to access assets like ourselves, the closed-end funds, particularly on the specialist fund section of the London stock market. You have to take a little bit of a test to prove that you're a capable investor.
Yes, that's caused a lot of issues, I know. Complex investments, exactly, which perhaps they aren't, yeah.
Hardly complex, though, I would say. As you pointed out earlier, when we IPO'd the digital fund, we set out a very conservative strategy. We said we would try and hit a 9% total return made up of a yield and growth in net asset value. We've clearly beaten that at just under 12% over the last sort of 4 years. But that's based on a fairly conservative outlook, nothing particularly racy. We invest in UK, Europe, and North America. We invest in digital infrastructure, and that's an asset class which has some very, I guess, predictable growing revenue streams. And we invest in middle market, which tends to be somewhat of a less crowded trade. We've invested in Poland, we've invested in the Czech Republic, we've invested in Ireland. All those are in the upper quartile, in fact, probably the best performing economies in Western Europe over the last few years. So what you find with this particular investment strategy, Jonathan, is that it's critical infrastructure. We have very important blue chip clients that want access to that infrastructure. The mobile operators want to put antennas on the towers. The use of the internet, government, corporations want to put their equipment in data centers. All of those same customers want to move traffic between towers, between data centers, to corporations, to government departments, etc. And because of that, they want long-term contracts. Because they want long-term contracts, we want obviously protections against inflation, so there are escalation clauses. And what you find when you add all that together is you get a very predictable growing revenue and cash flow stream, which allows you to pay a good dividend. It allows you to grow your net asset value over a period of time, which is exactly what we've seen over the last 4 years.
So if we look at that sort of industry or that sector in the round, as you say, there is obviously growth there. We all know that there's a lot of growth out there, but there's also a lot of competition out there, people trying to get into this. But is this a business where scale is important as far as you're concerned? In other words, what are the competitive advantages that you need in order to do well in these big infrastructure projects?
Scale is not essential, but it is beneficial if you have it in the geographies in which you're operating. So we are number one in the infrastructure that we provide in the Czech Republic. We're number one in Poland. We're number two in Ireland. We're number one in data centers in Belgium. These are smaller geographies. We have very, very strong market positions. We have strong competitive moats. And as a result of that, these are very much national champions, right, in the geographies in which they're operating. And as a result of that, you attract good quality talent. We have great CEOs running these businesses. We have great executive management teams. People want to work there. And in fact, two of our companies have worked, the best employer in the geographies in which they're operating a couple of times over the last 4 years. So all of this comes together to really create a very quality business, a quality asset that is well placed to service the critical infrastructure and services that people want. And it's very pleasing to see that, right? It's very pleasing to work with these quality management teams, to work with government, to work with the very important customers that we have, whether it's T-Mobile or Orange or Everything Everywhere, whether it's Amazon or other providers of the internet, whether it's the government departments, the European Commission, is a customer of ours. So it's very gratifying to work with these teams, to work with these customers in delivering the services that we deliver.
I should perhaps make it clear. I mean, I think I've got this right, that it's not like some other funds of this kind. You don't like to own minority interests in the things you invest in. Is that right? Why is that? What are the advantages of going for control over these companies rather than just investing passively in them?
Well, when we set out the trust, it was very deliberate to try to acquire, controlling positions in the assets in which we buy. We have in the fund, I guess, one of I would say, our unique selling points or critical success factors is that we're not your typical fund in that we're staffed with bankers and private equity people. Over half of our staff actually come from industry. I come from industry. I'm not a banker. I'm not an ex-banker or a private equity guy. I'm a multinational corporation executive. I've run, bigger and bigger multinational corporations in the digital infrastructure space over the last 25 years. In fact, I retired as president of American Tower Corporation some 5.5, 6 years ago, where I've been with the company for 12 years and been part of taking it up from a 15 billion market cap to close on 90 billion market capitalization. So when you've got the industry expertise, I think we have a view on the market, we have a view on the assets, and we can work more productively, I think, with the local management teams. We've been in their shoes, we know the challenges that they face, and we can work together. They've got local knowledge, we've got international knowledge. And I think that all works well in order to drive a better performance across the whole portfolio.
So I mentioned earlier that you use debt, obviously, to enhance the returns because you've got stable long-term cash flows and so on. So what is the sort of underlying rate of return on the infrastructure itself before you apply the gearing? And how does that compare to other types of core infrastructure that we know over here through the investment trust world? So things like motorways and those kind of big projects.
Again, back to that conservative principle, I would argue that we are fairly conservative in terms of the gearing that we apply to the portfolio, particularly when you compare it with similar types of listed vehicles across Europe and the US. And we don't have any maturity of our debt positions until June 2029. So certainly in a very stable position there. In terms of returns, we always look at assets on a discounted cash flow basis. We'll look at the business, we'll project the growth in the cash flows that we expect. We will discount that then based on obviously the risk-free rate, any premium for the jurisdiction that we're operating in, plus an equity rate of return. And that usually is in excess of the 9% that we said on the tin that we will deliver to shareholders.
Okay, so let's just talk then about your experience as an investment trust over here. I mentioned that earlier you've been on a roller coaster ride, or at least I should say the share price has been on a roller coaster ride. You've been doing what you're doing, and you've raised some more money at the beginning, but have not been able to do that since the shares started to move to a discount. And they went to a big discount. Now, what do you think were the main factors behind that? Was there some contagion from the problems that Digital Nine have had? Big problems they've had. They've mismanaged their debt and balance sheet. Or was it just the general trend that we've seen of rising interest rates having an impact on the valuations of anything which is deemed to be interest rate sensitive? How do you explain what's actually happened to your share price over that period, this huge kind of up, down, up again profile that you had?
Yeah, no, I think you're absolutely right, Jonathan. Obviously, there was some contagion from DGI9. The sector is fairly new to investors of the type that invest in investment trusts at the time, and therefore would they find similar issues with ourselves. And obviously, the other thing is interest rates. Interest rates were very low when we listed the trust. They went up substantially over that period of time. We had COVID, the continued ramifications of COVID. But also, I think we've seen two other dynamics as well. We've seen massive redemptions from our typical investors. They've been having to give money back to their retail investors, which means they've had to trim or exit certain positions. And we've seen consolidation in the wealth management and the fund management arena, which means that they're much bigger companies now. There's a less number of companies, investors, and they want to obviously invest in bigger and bigger assets. And we're sort of up there at £740 million market cap. But some of these funds now would prefer people to invest in companies, investment trusts, as sort of a billion or 2 billion in size. So I think all of these factors, together with perhaps some, I guess, industrial shooting themselves in the foot, this whole notion of double counting of fees has also been somewhat a distraction, I think, in terms of the attractiveness of investment trusts across the piece, not just ourselves.
So do you regret having raised the money as an investment trust? Would you have done better if you'd gone for some different kind of fund? And you do manage other kinds of funds as well. Do you regret that in any way?
No, no, not at all. I think we have raised substantial monies. I think we've delivered a good return over the last 4 years to shareholders. I'm very pleased with the businesses and the operating management teams in terms of delivering good progressive growth in revenues and EBITDA. I expect that to continue, as I've already pointed out, in terms of the type of business that we're in, the type of sector that we're in, the type of long-term contracts that we have with blue chip clients. And, Rome wasn't built in a day. And I'm hopeful that progressively the sector will recognize the quality of the business, the quality of the assets that we've got, and that ultimately we will revert back to NAV, and maybe we'll get a chance to raise some more capital. And if we do, there are more opportunities out there to be able to invest in. If we don't, we'll still grow the NAV. I think we'll still grow the market cap, whether it reverts to NAV at all. So no, I'm not disappointed. In fact, I think we've done something quite special here in putting these assets together, and some people have benefited from that. And I hope that those that stay with us will benefit a lot more in the future.
There's been a lot of discussion about the reasons for these discounts emerging and also for the absence of pension funds from investing in this kind of business, which you would have thought would be a very attractive business for them. At least they're not investing in it via investment trusts on the whole. Have you had conversations with pension funds about possibly investing in your trust or had any interest from them about that? And do you think that a government push on pension funds to invest more would be beneficial to you?
Yes, yes, yes. We've had some embryonic discussions with pension funds and whether our sort of asset class would be attractive to them. There is somewhat of a thrust, isn't there, from government in terms of trying to encourage pension funds to invest more into local equities. I think that's beneficial. Unfortunately, I mean, for many, many years now, the Brits unfortunately have a high marginal propensity to buy foreign goods and to invest in foreign stocks. It's the same corollary. And if you don't invest in your homegrown industries, then, it sort of becomes a bit of a self-fulfilling prophecy, right? It doesn't evolve. So I think encouraging the government, encouraging pension funds and others to invest in local companies, listed companies, private entities, I think is beneficial. And certainly where individuals are getting tax benefits on such investments, why shouldn't the government be requiring that sort of approach? We see all the notion of LTAFs now being encouraged to invest in private assets. And I'm somewhat bemused that there seems to be a lack of recognition that investment trusts have been providing individuals and wealth managers access to private assets for many, many years. Have been raising capital to invest in private infrastructure and has a tried and tested sort of board governance and regulatory regime on which it's been working under for many, many years and has a high degree of daily liquidity, right, for people that want to invest in those. And then we come up with a new mechanism called an LTAF where liquidity is nowhere near as obvious. The governance is at best going to be emerging, right, in terms of, and there seems to be this desire to pursue the LTAFs rather than really talk up the real success of investment trusts over many, many decades. So I find that a little surprising. And of course, I think it's beholden to me, perhaps you, Jonathan, perhaps other members of the community to try and, I guess, raise the true value of investment trusts and the contribution to the wider economic prosperity of the UK and encourage, wider investment, government and regulatory support. And this whole notion, again, of government wanting people to invest in private assets and then turning around and saying, but investing in an investment trust wouldn't count. It doesn't really make any sense to me.
Well, there is no sense behind it. It's true, I think, other than there's a kind of ideological mindset in certain parts of government and the regulator that can't handle the idea of discount volatility. I don't know what other reason there could be. But I mean, I suppose I should put this to you as well. The flip side of this, the investment trust structure, is that you have traded at a big discount, 40% or more at one point, and you're now at 25, something like that, that somebody will come along and just try and take you out. That would be private equity or even a larger player in your own field. And that would be a great shame and a missed opportunity in a way for the investment trust sector. So how do you think about that particular issue?
I agree. I agree entirely, Jonathan. It would be a great shame if we're taken out, but we're here to do the best for shareholders. And if we can't get back to NAV, and that's a reality, and somebody does decide to pick up the assets, I guess that's the way of the world, and we'll respond to that appropriately in the best interest of shareholders. But I've had this question on a number of occasions from investors and other stakeholders in the community, sort of saying, as you've just said, it would be a sad day again if it's taken private for the investment trust sector, which is such a great mechanism and has proven itself over many years. And it would just be another nail in the coffin, right? We've seen BCI take out BBGI, and that was a good asset and a good investment trust and could not be supported in its continuity as a publicly listed vehicle, right? It was taken out.
To put that in numbers, I mean, your share price is now just edging back up towards where it started, basically. You're back up to about 99p, and you've started at 98 after the cost of the issue. But the NAV is up there 129 or something like that, isn't it? So it's very much a real issue. But the trend has been very positive. You've got momentum behind it. What have you been seeing in terms of the share register and buyers coming in? I mean, what's been driving this resurgence, if you like? Is it just a small amount at the margin, taking advantage of the fact that the discount was so wide, or are you actually seeing new investors coming in on the share register that actually might help to sustain that recovery on a longer term basis?
Yeah, well, I think we saw a couple of early significant investors in the fund suffer some very significant redemptions and had to trim or exit certain sectors. And I think that's what, against everything else that we've talked about, the higher interest rates, the COVID transition, resulted in, I think, a discount across the sector, not just ourselves. I mean, we saw the Rolls-Royce investment trusts of the sector also with unusually high discounts at that point in time. What we've seen more recently, I would say, over the last 9 months is some new investors coming into the stock, some really high quality investors coming into the stock that have been, I think, sitting on the sidelines. I mean, one in particular, I've seen them every year for 3 years and they've not bought in. Very recently, they decided to buy in and they bought in a big way. So we have now seen new investors coming in. We've read a lot in the paper, haven't we, about people, investors coming over from the States or international investors maybe pulling back a little bit of their investments in the States and investing more in UK, Europe. I'm not sure that we've seen much of that in our particular stock at the moment, but one would expect to do so, I guess, at some point in time. So I think, yes, the discount is obviously a very attractive buying proposition, but I'd continue to add to my personal holding over the last 24 months as a result of what I see to be absolutely great buying opportunities for certainly my balance sheet. And at the end of the day, I know that we can grow the NAV, and whether we revert back to NAV or growing in the NAV pulls up the market cap, then I'd expect that to continue.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. I've got a couple more questions about the trust itself, but before I do that, perhaps I could just ask you, inevitably, to say something about AI. We know that there's this great arms race going on between the big firms, the big tech firms that are trying to establish themselves as the leaders in AI, and in the process of that, they're spending huge amounts of money. And presumably you're benefiting from that, at least in some sense, because of your data centers and so on. What do you make of that arms race? How long will that go on? And do you have a view about who's going to come out as the winners out of that? Because not all of them can be winners.
Well, I don't have a view of who's going to come out as a winner, but I certainly do recognize that it is highly beneficial to the digital infrastructure asset base that we own. As I said before, simplistically, you can call the assets that we own the plumbing of the internet. And the more traffic that goes over the plumbing, the more we earn. So with AI, it's going to vastly increase the demand for data center capacity. Those data centers will need more fiber optic capacity to be able to access the information and move it back and forth between the users and those that are established in the DC. It will inevitably require more capacity on the mobile telecommunications network because you'll be accessing AI analogs through your mobile phone. So it's going to drive much more demand for capacity, and that's what we provide. More fiber optic network capacity and more data center capacity, more space on the towers for more and more antennas.
So you mentioned where you've been investing, Poland and the Czech Republic, and now also Belgium and Ireland. So very much a kind of European focus at the moment. You mentioned that Poland and the Czech Republic are among the fastest growing economies in Western Europe. So where will you be looking next if you want to invest further? If you get an opportunity to do any more, if the market allows you that in due course, where would you be looking to go? Do you want to diversify further, or are these same countries more attractive still?
Well, we have either cash or available debt lines of around about a couple of £100 million. So with that, the strategy is really to hold that back to ensure we've got sufficient funding for good organic growth. whereby our bolt-on acquisitions. So organic growth is where we would build an extension to the data center. It's where we would run more fiber optic lines into, for example, the Dublin airport recently. We've just run a fiber optic connection into the Dublin airport. We've run fiber optic connections into various industrial parks in Ireland. And we would build out more mobile telecommunication towers. And again, an example of that would be we just won a contract with Orange, the mobile operator in Poland, to build out another 325 mobile towers for them over the next sort of 2 to 3 years. So investing in organic growth is extremely attractive. You're not paying an acquisition premium. Utilizing the existing sort of back office and SG&A that you already have, and you tend to generate a very, very good internal rate of return on those assets. Secondly, as we've got additional cash, we would certainly encourage the management teams to, where they see opportunities for bolt-on acquisitions, they also tend to be driving extremely good returns in that, again, utilizing your existing SG&A, your back office, you've probably got revenue and cost savings as a result of those sort of acquisitions. So that's where we prioritize our spend. I mean, if we did get the opportunity to raise additional equity, there are very compelling opportunities across Western Europe now, in the Nordics in particular, that we would certainly be on the phone and proactively pursuing if we had the ability to raise substantial additional capital. As it is, we're having to decline, to get involved, sometimes on a unique basis with potential asset sales that would absolutely fit so well with our portfolio. But that is what it is. So at the moment, we keep exploring whether we can raise additional money through perhaps some separately managed accounts in order to be able to pursue some of these assets in joint venture with the listed vehicle, which would further diversify our asset base and potentially allow the listed vehicle to buy up into those assets over a period of time if it can raise capital in the future. So we'll look for other ways to try and solve that equation, but certainly it is limiting. And as I said, it is a buyer's market at the moment, so that there are really great assets at good prices and good contractual terms and conditions at the moment if you've got the capital to pursue them.
So perhaps I just asked the obvious question. So why is it a buyer's market at the moment? If we're going through this period of very attractive assets and they're growing fast and so on, you wouldn't expect that to be a buyer's market.
It's a buyer's market because a number of people have bought assets in the past at perhaps slightly inflated prices. They've been bought by private equity. They've held them for the normal sort of holding period, 5 years. We're now into the 6th or the 7th year. They've had holdovers. Their LPs are asking them to repay capital that they were expecting to get back after 5 years. So there are a number of assets that private equity would like to sell, and they can't sell because there are a lot of assets out there. They bought these at slightly higher prices, and because they can't recycle the capital, they don't have the money to buy other assets either. They can't give the money back to the LPs, then take more money from the LPs to buy other assets. Now, that's not the case with the mega funds, the really big funds that are raising 5, 10, 20 billion. They seem to be able to raise money pretty quickly and they can go out there and buy assets. But they don't want to buy assets that are the size that are of interest to us. They want to buy assets that are valued at 3, 4, 5 billion. Whereas our typical interest is for assets somewhere between sort of 3 to 700 million, less crowded trade, smaller markets, and it's the people that would naturally go for those. They don't really have the capital. They're not recycling the capital. They don't have the capital to be able to pursue them quite as much as they did historically. I don't know if that makes sense, Jonathan.
It certainly makes sense about private equity. I mean, we do know that they are struggling to dispose of things, and heaven forbid that they might have paid too much for something. I mean, what a terrible thought that would be. So let me ask you then about something else, which is, I mean, your two biggest assets, I think, are called CRA and Emitel, and they both seem to be performing well, revenue growing and earnings growing. But you do have one holding which has been, I think, a disappointment, and that is something called Hudson Interexchange. And I think going back to the IPO, you were quite excited about that at the time. It's based, I think, in Manhattan and servicing the US financial industry in particular. What's the story there? Why is the value of that coming down according to the latest results?
Yeah, it's a small asset. It represents only, I think, 3% of our asset base at the moment. It is a fairly small data center situated in the building at 60 Hudson in Manhattan. And that building is iconic. It's probably one of the most interconnected buildings in the world. Manhattan is not known for its cheap real estate, as you may well imagine. So people don't go into that building because it's a low price, right? They go into that building because there's so many other corporates or governments or managers of the internet in that building that they want to interconnect with, have low latency and reduce their interconnection costs. So there is a particular type of customer that goes in there. We bought that asset when it was loss-making. We bought that asset for a price less than the equipment would have cost to build and develop that data center. And we had a view to move it from a loss-making position to a profitable position, and it would be a growth asset for us into the future. I have to say, I think we didn't have the right management at the time, which perhaps took me a little bit longer to move on than perhaps I should have done. We now have the right guy running it. We have better visibility on what we need to do in order to deliver, and we've beaten the budget in the last 12 months as a result of the new management that's involved there, and seeing a lot more interest in the space, such that we have committed to building out 2 new data halls. So with these sort of data centers, Jonathan, if you imagine sort of a warehouse floor, and then you have to build up the partitions, you have to build out the fire suppression, you have to build out the hot aisle, cold aisle sections. You have to then install server racks. And that obviously costs you some money, the fit out, if you will, of the data center. So we've just approved the building of 2 new data halls to fit out all those things because we're running out of space that's fitted out. And we're seeing good demand for that now. So slower than we'd anticipated when we acquired it, but I think we're now on the right track, although it'll be I'm banking on modest progress as opposed to rocket progress on a go-forward basis.
Would you get rid of it if you could?
I think we could sell it down, and the reason why we would sell it down now is because the original thesis was we would invest further in the States. We would buy an interconnect data center on the West Coast. We'd probably buy one in the Midwest. We'd buy one down in Florida. We would interconnect all of them. We would cross-sell across the different properties. That sort of strategy is difficult to pursue now because we don't have the ability to raise the additional equity that it would need. So on that basis, if we got the right sort of price for it, then yes, I would have to consider selling that down.
So perhaps I should also ask you just about the dividend. You pay a dividend, which is obviously attractive. Currently, I think around 4.5%. And you say that it's well covered on an adjusted cash flow basis. Always a bit suspicious when you hear adjusted cash flow basis. What do you mean by that? And how do you quantify that cover? How secure is it?
Well, I think it's 4 times covered by EBITDA, if people recognize that metric. But after EBITDA, of course, you've obviously got to pay your interest charge. You've got to pay your maintenance capex. So adjusted fund from operation, AFFO, is a very standard metric that is utilized throughout the industry across Europe and the US. And effectively, it's saying that after we've paid all of our interest charge, after we've paid all of our SG&A charges at the center, after we paid our maintenance capex, we're still 1.2 times covered. So it is very, very well protected. And we could clearly pay a much higher dividend if shareholders really wanted us to do that. But we do pursue a buy, build, and grow strategy, which requires us to continue to invest in more growth assets, as I've talked about already, which we also get the opportunity to invest in bolt-ons. So, if you pay it all out as a much higher yield, then you're restricting your ability to invest in growth assets and to grow the NAV as quickly as we've done in the past.
For obvious reasons, I don't want to particularly dwell on the experience of your competitor DGI 9, but sitting from where you're sitting, they obviously had a different approach to you. So they took on too much debt and they didn't control the assets outright. I think it's fair to say. Were there any lessons that you were able to learn from their experience? I mean, they're still with us, of course. They're still trading on the market, and some people think they might be worth a bit more than they are at the moment, but it's small pence, really. But do you have any comments to make on that?
Well, I think we've always followed a somewhat more conservative financing strategy than DGI9 did. An important point for people to recognize, I think, is that many of the assets that DGI9 acquired are not bad assets. They're good assets, digital infrastructure assets. They're great assets in some instances. Maybe DGI9 paid a little bit more than they should have done, but that's not necessarily the biggest problem. Unfortunately, a number of the assets were somewhat cash consuming in that you needed to build out more of the infrastructure to fully monetize the value. A big data center, for example, in Iceland that needed a lot more expenditure, and therefore they weren't getting, like you've alluded to a couple of times, Jonathan, it was really a balance sheet. It was a financing proposition that caused their downfall rather than the quality of the assets. The assets weren't generating cash. You needed to continue to invest in them. And when the market shut down and they couldn't raise additional equity from their investors, then they couldn't fund the dividend, which of course is a big disappointment to investors. And the share price obviously crashed, and they had issues with meeting their debt covenants. And ultimately, shareholders said, let's wrap it up. But it's not the quality of the assets, right? It was just the management of the financing of those assets. They're a victim of the closing of the markets. And I guess that's what you've always got to be wary of, right? You need to be able to live with the cash flows that your operating companies are generating rather than have to rely on your ability to raise more equity. Otherwise, you're in trouble.
So they're in wind down mode. Would there be any interest on your part in picking up the pieces?
No, they have a fixed wireless access business in Ireland that would fit very well with our Speed Fibre Group. They've decided not to sell that at the moment, but certainly we showed interest in that some time ago. And then Arqiva is their last remaining asset. And I used to be the CEO of the precursor to Arqiva as it's defined now. So I really understand that asset. I know that asset. Again, I don't think it's a bad asset. I mean, I think they overpaid for that asset quite dramatically because some of its revenues are going to run off over the next few years. But from my perspective, I think it'll still be a good asset. It'll still have a good long runway, although some people think maybe not. So I guess every asset's got a price, right? And you just got to make sure you don't overpay.
Indeed. Okay, well, I think I'll leave that comment where it stands. So finally, Stephen, thank you so much for doing this podcast. Essentially, I think what I'm hearing from you is your story is that you're still in a growth market and share price is recovering, your earnings are growing. What are the biggest risks out there? I mean, it all seems too good to be true in a way, and you're buying it at a 25% discount. So what are the risks out there as far as you're concerned?
Well, I guess if interest rates go up, I think that's obviously a risk. Most of our earnings are from international earnings, so I guess there's some forex risk. But as we're in the three fastest growing markets in Europe, I would expect those currencies to outperform the UK's sterling over the long term. You may get some ups and downs. And as a result, because we always value to develop our NAV every year with third-party valuers, they will obviously look at the cost of debt. They will look at the risk-free rate. They will look at currency implications. And if the world looks a riskier place, I guess the risk rate goes up and the valuation, it puts a bit of a drag on the growth in the underlying revenues and profitability. So everybody would suffer the same sort of thing. But yeah, I don't see particularly serious risks ahead of us, but we need to monitor the things I've just mentioned.
I suppose one can't really talk about extreme events like terrorism or cybersecurity or any of those things that physical assets are vulnerable to, or perhaps weather, climate change.
We have a little bit of exposure to that, but not a lot because, as I say, we own the real assets. So when we own a mobile telecom tower, we own the physical steel, right? We don't own the antennas and the base stations at the bottom. That's all owned by the mobile operators. So there's not much data you can steal off a tower, right? It's just a physical structure. But of course, we do have back office. We do have information on our customers, and people can steal a bit of that, and that can cause you a bit of trouble if they do that, compromise your data integrity. But generally, we're not as vulnerable as perhaps many companies because of this real asset nature. The data center, we own the building. In the main, we don't own the servers and we don't own the data that's on the servers. Now, we do offer a cloud service, so we have a little bit of that, but it's a small part of our revenues.
What about availability of water or planning regulations? Are they issues for you? How do you manage those?
Well, if you're building a data center, you really need to secure, contract the power requirements that you're going to need for the building. So we have that. We have the highest level of contracted available power in our Manhattan data center in the whole of the building. We have contracted power across all of our data centers across Belgium. And we are now looking to build a state-of-the-art 26 megawatt data center in Prague, the Czech Republic. And getting the permits, environmental, the planning, the zoning permits for that has taken us over 2 years. So it is difficult to get the permits. But we are actually developing an old site that we owned. It was an AM radio site, not an environmentally friendly radio solution. So we've decommissioned those 3 AM radio towers on that site. So it's a brownfield site. It's got a substation that used to power the radios. And it's got access to fiber connectivity that used to deliver the information to the radio towers. And now we have all the permits, we have a design, and we've broken ground on a 26 megawatt data center. That will be a state-of-the-art facility in the Czech Republic. We will be the biggest provider of data center capacity in the Czech Republic if, in fact, that gets built. At the moment, we're just doing ground clearance. We're in discussion with anchor tenants, and assuming we get sufficient interest, then we'll obviously commit to the building out the core and shell.
So these are all problems that can be dealt with. I guess there's always the unknown factor. So, Stephen Marshall, I'd like to thank you so much for coming on the podcast and talking to us about Cordiant Digital Infrastructure, ticker CORD, currently bouncing back after a tough couple of years.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.